Hello, and I guess I should start off by saying Happy Earth Day and welcome to today's webinar. Uh, today's webinar, Protecting Our Tomorrow, where today we're going to be discussing sustainability and ESG investing. My name is Andrew Gradus. I'm the Director of Investment Consulting at Adhesion, and today we actually have quite a bit of ESG experience on the call. Myself with over a decade of ESG experience, and I get to apply that to Adhesion's direct index business. But much more importantly, we're joined today by Doug Classen and Bob Gray, both from Dana Investment Advisors. Bob, I see that you have your green Earth Day jacket on, so it's very, very festive of you. Both of you being from Dana Investment Advisors, Dana has over 22 years of experience in ESG investing, launching both a social ESG product and a faith-based ESG product back in 2000. So first of all, I'll say, Doug and Bob, thanks for being here today.
Thank you for having us.
And well, great. With launching two products just back in 2000, Dana was launching ESG strategies right as ESG started to get interesting, or it started to evolve from the 1990s, where everything was just screening out alcohol, tobacco, firearms, and nuclear energy. That was basically the gist of it. A lot has changed since then. So I guess for today's conversation, it would help to start with setting the stage. I guess Bob, I'll start with you. As far as at Dana, what is ESG investing to you?
Sure. Well, thank you again for that kind introduction, Andrew. And just on behalf of Dana Investment Advisors, Doug and I truly appreciate the opportunity to participate in today's webinar, and just thank everyone for their valuable time this afternoon and interest in ESG. I think ESG investing is really what I should try to define for everybody rather than just ESG. But let me start very basic and just make sure everyone knows what the E, S, and G stand for first. E stands for, and some of you may write this down, but E stands for environmental, S stands for social, and G stands for governance. And I will expand on each of these a bit further in a moment, but as you correctly phrased the question, Andrew, ESG investing is actually a form of investing that has been around many years. You kind of referenced that. And it's been known by or referred to using many, many different names. SRI investing, kind of standing for socially responsible investing. Sustainable investing, impact investing. Some on the call may have heard of mission investing, or as you pointed out, Andrew, faith-based investing. These are nuances, and there are nuances to each of these terms and approaches, but it's fair to say that ESG investing does a pretty good job of capturing a common thread that all of those really share. And what is that? ESG investing is an investment discipline or approach, I like to say, Andrew, that considers the impact of environmental, social, and governance factors on a company's long-term financial performance. So that's a mouthful, and there's a lot to unpack. But what makes ESG investing a little bit different is that traditional non-ESG investing also would look at traditional financial measures, of a company's kind of predicted success, like growth and profitability, cash flow, strength of the balance sheet, strength of management. ESG investing just combines consideration of those ESG factors along with those traditional financial measures. Stated another way, ESG investing has advanced investment theory or analysis to think about how corporate behavior and intention can impact a company's value and likelihood of sustainable success for shareholders. And very important, and for the first time, stakeholders, not just shareholders. And what do we mean by stakeholders, Andrew? They are the related parties that all businesses encounter: vendors, suppliers, employees, customers of one type or another. And really, before turning it back to you, Andrew, on kind of what is ESG investing, I promise to expand just a bit further on E, S, and G. I think examples would be the best way to understand what a portfolio manager actually is thinking about and considering when he's looking at E, S, and G. For environmental, questions like this are often considered and analyzed. How efficiently does a company utilize scarce resources such as water, energy, fuel? Another question might be, is a company an excessive greenhouse gas emitter or directly exposed to nuclear power, let's say? Or lastly, maybe, does the company routinely face large EPA fines, Environmental Protection Agency fines? What about social? Does the company have a history of labor strikes or work stoppages? What about the following, do they follow fair labor practices? Do they use child labor, things like that? Is the company exposed to oppressive regimes or civil instability? And lastly, when it gets to governance, that's really how a company actually governs itself and follows rules and policies set within their industry. Do they have an independent board of directors? Things like that, independent audit committees. Anyway, deep research and extensive analysis are done around all those areas, in addition to traditional fundamental financial analysis, before really decisions are made that go into an ESG portfolio.
Great. No, appreciate that thorough explanation. I know that we've seen over the years, ESG conversations have become much more prevalent and commonplace. For years I heard people say, everybody's talking about it, but very few are actually investing. And we've seen that shift quite a bit over the recent years. And so, Doug, I'll ask you, tell us a little bit about the growth in ESG overall that you've seen.
Well, I'm so excited. I don't know if I can answer it in a few minutes. There's a lot to cover, but the growth has been very large, and you'll get a wide range of numbers. Some people today will say that it's $1 out of $4 in America, write this down, that's professionally managed has an ESG overlay of some kind. Mm-hmm. And obviously 10 years ago, it was next to nothing. So if it's anywhere close to that now, then what will it be in 10 years? Huge. The year-over-year growth rate is probably around 30%. So we all of us on this call need to be ahead of this thing, not behind it, chasing it. It used to be, like Bob said, I echo, avoiding the bad, capturing the good, but now it's capturing the good also. And it is growing. Here's the things that I think that help set you apart and make it beneficial for all of us. It's a growth industry. We want to be in that, all of us. Number two, it sets you apart, makes you a niche person, a niche player, an expert. But the whole thing ends up being risk mitigation and adding value through non-financial factors, corporate governance, that end up helping performance. So we're winning here. We're doing some good, but if we had an hour, we could prove it to you that the performance ends up being even better. Okay, I'll stop there. I think the question was, is it growing? Yeah, it's growing, but it's growing for a lot of good reasons, and all of them make good sense.
Sure. And, and there was actually an article in Barron's last week, and it referenced a study by the FINRA Investors Education Foundation. And that was a survey that found that really it was today about 9% of retail investors say that they have ESG related investments. So retail, I think, has been a little bit slower to adopt, but at the same time, you look at the phrasing of the statement, retail investors who basically are aware that they have ESG related investments. So, talk a little bit about that slower adoption rate and, and I guess how that phrasing is worded there.
Well, okay. And I don't know if they're right about the 9%, but that's good because that gives us time and opportunity to catch a market that hasn't matured yet. I don't want to be late. I want to be early and bring the good news to all these people. Where it started really was in the institutional markets, the foundations, the endowments, the charities, the not-for-profits, the private universities and colleges. And now it is growing fast in the retail space. And I'll give you 4 spots, okay? 4 spots. I don't know if I'm correct. Some are stronger than others. but millennials are huge adopters. And the next generation, as wealth gets passed to them, guess what? Guess what they're going to care about? ESG. Women, another area of where it's strong. And then faith-based people, faith-based institutions. And then the coast, East Coast, West Coast, very much into this whole scene. So if it's 9%, which I disbelieve, great. That means we get it to 20, 25% in the next 2 years, the three of us here on the call.
Sounds good. And and Doug, you referenced this a moment ago about the performance, and I think ESG basically in the 90s had I think a deserved reputation for underperforming, but that it really has come full circle since then. And ESG has outperformed a bit more in recent periods. So just thought let you comment on that. I know a lot of it has to do with governance and things like that, but talk a little bit about the shift from 90s underperforming to today we're seeing strong performance.
Well, and again, the governance, what makes non-financial factors, and we can talk for 45 minutes, what makes good management team and good governance policies for a company, and ultimately, and we'll give you a few examples at the end of what bad governance, but if it's good governance, good management teams, do they own equity in the firm, 3 years of their salary, all kinds of good labor relations, middle management turnover, all kinds of things like that, that has nothing to do with the PE ratio, but it's a good management team that's going to run and do the right thing for a company. That has ended up helping performance in a positive way and avoiding some of the risk mitigation, litigation, and so forth has protected on the downside also. So again, I say it's avoiding the bad and capturing the good. There's two sides at work here. Corporate governance might be the center of it. It's only part of it though, but ultimately ESG funds are now outperforming, if you go through many market cycles, their counterparts. And at Dana, proof in the pudding, okay? 20-year track record. Our two ESG strategies, one faith-based, one just social ESG, have outperformed our large cap strategy that, is just own anything, we're not doing any real screening, so to speak. Well, if it's third and social ESG is second and the faith-based is first, that's because Bob's praying for that one, then ESG has something that's valid. It's our best performing strategies. And it's because we negative screen and positive screen. And by the way, Dana was early to that race of integrating positive screening rather than just a negative screening. And we think that's a difference maker.
Sure. And I know a lot of where, when ESG outperforms, it's typically more in volatile markets and down markets. And, so I'll open this up to either you, Bob, or Doug. I know you have some examples of some of the ways that this has actually taken place and manifests itself. And it's really not that surprising once you start talking about that.
Yeah, you know what? Let me give you a few examples of avoiding bad situations through ESG screening and some specific companies, and it hurt the companies dramatically. And it's the ESG crowd that caught them and held their feet to the fire. But British Petroleum, when the Deep Horizon platform blew up, was no surprise to Dana. They had the worst track record, the worst safety record, worst training record, worst maintenance record in the industry. Well, that's a stupid thing to do when you've got an oil rig. And is it any surprise that that's the one that blew up? Okay, next example, Royal Caribbean Cruise Lines. I'm a scuba diver. They went around 10, 15 years ago dumping sewage into the ocean. The ESG crowd caught them. Well, that hurt them. They got fined, but a lot of people won't get on a Royal Caribbean boat to this day. Me being one of them, because I've been underneath the water, and if you're going to dump sewage into the water in the ocean, I'm not getting on your boat. And so it continues to plague them. And the ESG crowd group industry held them accountable. Boeing, we sold Boeing a day or two after the second wreck, the second plane crash. Everyone said, hold on to Boeing, they're going to be fine. We looked at it and said, there's a governance problem here. These guys were not training properly, not good record keeping, bad communications, using simulators that weren't up to speed, all kinds of reasons why that wreck happened. We sold it the second day. The rest of the industry that didn't suffered a lot more. Last example, Nike. Years ago, they were in Asia chaining kids to the workstation, their work desks. Well, I'm a dad, I'm a grandpa. You do that to my kids, I'm never buying one of your shoes. I buy everybody else's running shoes. I'm not buying, not Bob won't either. We're not buying Nike shoes. Don't do that. That's the wrong thing. So corporate governance, ESG, this isn't just a world about PE ratios anymore. And when you start screwing it up at the corporate governance level, that means bad management. You don't have to be smart to figure that out. And it will hurt your company. And the list goes on and on. Enron, you just named it. When you have bad management, bad corporate governance, look out. So yes, ESG has outperformed. And in my mind, if you capture the good and avoid the bad, you will continue to outperform because you're now taking financial factors and mixing it with non-financial factors that deal with character of management. And that means everything.
Sure.
Hey, Andrew, the thing I might add to Doug's comments about those 4 great examples around, governance and what that additional research and work beyond the financials can expose. Does this additional ESG analysis, I'll call it, around governance in particular, does that guarantee that all corporate misdeeds and wrongdoings will be uncovered? I mean, of course not. But from a risk mitigation standpoint, if you're an advisor on this call, wouldn't your clients prefer to be invested in strategies that do this extra work and minimize those chances? Of course they would. So I think the moral of the story is ESG investing does a good job of, Andrew, I use the term bubble wrapping a portfolio. Have we received things in the mail that are bubble wrapped and broken? Yes, but not often, right? But bubble wrap does a good job of protecting the portfolio and providing some of that risk management downside protection you referred to.
Sure, absolutely. I'm throwing my own example. I know many portfolios had already removed Volkswagen or the VAG group prior to the admission scandal. So certainly was not a big surprise to a lot of ESG investors there. And Bob, you just mentioned investors and client conversations and so forth. So want to shift to that direction. I know you guys are traveling every week. You're talking to investors. How should advisors introduce the topic and talk about ESG with their clients? And Bob, I'll start with you.
Yeah, sure. And Doug is going to have a few stories to share, but a couple that come to mind are, first, my roadmap for advisors to start the ESG dialogue. I suggest that they start by asking their clients right up front if they would be interested in aligning their important beliefs and values in how they invest their money. I figure, Andrew, if nothing else, our business is all about getting to know your client, right? And I think just that question is going to reveal a deeper understanding and build a deeper relationship with your client. So nothing ventured, right? Nothing gained. But most clients will be intrigued by that question, Doug and I have found. It's kind of like a light bulb goes on. Oh, I didn't even know that was possible. So tell me more, right? Next, I would ask the following leading questions. Once you've teed that up, I would then say, now, if we could do that, would you also be interested in an approach to investing that gives us a good chance of doing better than the market? Now, if that's not a leading question, I don't know what is. I think most clients would say, of course, right, tell me more, right? But this is part of the sales, but also the educational process. So then I would say, okay, then what if we could also find an approach to lowering the risk or the volatility of your portfolio? Again, what are most clients going to say? Oh yeah, well, tell me more. Yeah, I'm really curious. But then lastly, and this has closed a lot of business, Doug will attest. What if you asked your client if this approach could also give them an actual way of measuring their investment's impact on what is really important to them, like what really matters to them. Well, all of a sudden, in most cases, those leading questions, checking all the boxes on performance, risk mitigation, measurable impact, it's usually going to open the door to further discussion on ESG. Your client is intrigued and you've delivered the trifecta of value. That's what Doug and I call it, the trifecta of value. A second real quick story, and then I'll let Doug comment maybe on a couple of his, is something I run into all the time. An advisor has a great long-standing relationship with a client, right? Usually the patriarch or matriarch of a family. And often it's the husband and wife together, right? We all have those clients. We know the industry statistics on keeping that relationship when that client or the couple eventually passes on, right? I think it's only about 20% that you retain those assets once they are passed through inheritance to the next generation. Well, I have an answer to increase those odds. ESG. We didn't mention it earlier. A lot of current growth in ESG is coming from, and Doug did mention it, women and millennials. Take advantage of that fact and invite sons and daughters of your clients to the next meeting. Frame it around socially responsible investing, ESG. There's a better than 50-50 chance. I have 4 millennials, so again, I can attest to it, that are going to be very interested in talking about those topics on the fringe or in depth. And whether college age or somewhere on either side of that, millennials are very interested in making the world a better place and feeling they are personally making a difference. So give that a try, because we all know it's hard to get that second generation to the table unless they are intrigued by or feel they can contribute to your meeting. And if you can begin building a relationship with them now, you increase your chances of retaining those assets to about 80%. And that's a pretty powerful incentive alone to introduce a client to ESG. Now, again, I'm sure Doug could share a couple of his experiences too on just how he is raising ESG with clients.
2 thoughts there, Bob. Number one, we kind of have 2 avenues for you. Some people may say, well, I'm not about the environment, or, I'm not into this. I'm not a tree hugger. Okay. Do you like pollution? Do you love smog? I mean, come on. Shut your garage door, leave the car running. Tell me how you feel in 20 minutes. Maybe. But there's people of faith out there also. So we've got a second audience, and it can be in Oklahoma or wherever that maybe you wouldn't classify as environmental, but they're faith-based, and they've got values in their heart and in their church that they want to adhere to. Okay, bingo. We've got another conversation going. So now you've got 2 roads to travel here, and you don't get shut out by one or the other. One last thing, as I'm looking at the clock, if you want to look for, and don't call on the biggest endowment funds, but if you want to find some small institutions to build your book, here's how you do it. And get out your pen. Just go to Google. My kids taught me how to do this. And Google in your area endowments, then foundations, charities, not-for-profits, hospitals, private colleges and universities, churches. Every one of these, you're going to get a hit list of 5, 10, 15, 20. Your city, your county, your state. And I called on the Notre Dame Endowment Fund once. That was a big mistake. It was all NASA rocket science engineers in there. I was way over my head. But the local endowment fund and foundation and hospital in your community is well aware of ESG. You can call up, go to the website, find the treasurer, the CFO, and ask them if in their investment committee meetings, if they talk about ESG investing. They're going to say yes. They will. Then game on. You've got a conversation. If they say no, then you say, well, this is big in your area. Can I come by and talk to you about it? So either way, you've got a conversation. So there you can start to slowly build a list of small client institutional prospects that you can start to add to your book. And they're open and willing. They like to talk about this topic. So do not be intimidated. Google them and call them. You will start a new journey. And call Bob and I if you get stuck and need some help there. We can help you on that path.
Great. As we're getting close to the end of our time, I do want to invite our attendees to ask questions. And while we're waiting for questions to come in, and I believe we have one already, so Doug and Bob, leave a little extra time there. But I just wanted to say what help can be provided to advisors. So they're going into the conversations, they're looking for taking that next step or adding a little bit more or generating additional interest. Just talk a little about the additional help that's available for them.
Go ahead, Bob.
Sure, Andrew, and it is kind of on the fringe of that earlier question you asked. And Doug and I, not certain whether it's 9% of retail investors are invested or if it's a larger number, but we all want to be at the front end of that, right? I think it offers an incredible opportunity for every advisor on this call. We are always asked, what's your value add, right? Well, why don't you be the first to educate them on ESG? And this is something we do all the time with advisors, like Doug mentioned. It's a specialty of ours that we are very good at, and a terrific way we can partner together. One of the things Dana came out with, and we'll leave time for that question or two, Andrew, is we came out with an ESG questionnaire that's very user-friendly. We'd be happy to provide to any advisors on this call or that may listen to a tape of it later. And it's a great, easy to use questionnaire with clients to get them educated on ESG and to actually open clients' eyes to what ESG really means to them. And it's a great tool to also start and advance the dialogue. So we'd be happy. It's a resource at Dana. This is not promoting Dana. This is all about ESG and education. So we could always provide that.
And if you need us out there to help you with a lunch and learn with a group of clients, that's what we do. We're boots out on the road. So we'll come out and do workshops or client dinner appreciation events and talk about the topic educationally, not about Dana. And that, I think, really helps you over the hump also.
Sure,
Yep.
Absolutely. So did want to go to the question that we got through the line. It's and actually I see this similar issue. It's many clients latch onto one thing, such as electric vehicles, and it somewhat becomes difficult to broaden the overall ESG conversation. So how do you direct conversations in those situations to help understand the values of that particular investor?
Let me take a shot at this, Doug. I think it starts fundamentally with how one builds a portfolio, whether it's an ESG portfolio or a non-ESG portfolio. And I think I'm speaking for a lot of professional money managers, but we would take something like electric vehicles, and maybe that's a hot button in a good way for clients, and they either want exposure to electric vehicles. Dana's approach in that segment of, again, environmentally friendly, industry is one that we still fundamentally, we look at profitability of a company, likelihood of sustainable success, and we weigh that with, again, the ESG rankings and scores that these companies have. It's very possible, Andrew, and the person who asked the question, that most of the EV manufacturers still aren't. Tesla's probably a good example of another case, but where they aren't even making money yet. They're still very early on, 3, 4, 5 years. And I think if clients want to be in the early end of, electric vehicles and making an investment, they want to make probably an impact, investment, and not really try to get that exposure through a diversified ESG portfolio. Most of the ESG portfolios are going to be built to represent the broad market, be very, very diversified, and have a very important investment discipline that they follow.
Good answer.
Sure. Yeah. No, and I know we get similar things, and so we at Adhesion we're able to customize direct indexes to sort of hit people's individual causes. I find that still the consistency with sort of off-the-shelf ESG portfolios are there, and a lot of times it's sort of a best-in-class approach. Take that person who likes electric vehicles, they still tend to recognize that all industries are needed to make our economy run, and which companies are doing the best job of managing the unique opportunities and risks within their specific sectors. Very different for oil and gas than it is for software and services, but give me those that are adopting the best practices, and I know their competitors are watching. So that's another avenue, is just sort of talk about the broader approach. And then you'll find within these ESG portfolios, a lot of those, with the more of the impacts are already included in the portfolios as well. But just talk about how, if you like electric vehicles, there's a reason for that, and probably it's somewhere connected to global warming and things like that. So,
exactly.
Well, great. Well, first of all, I want to thank both of you, Doug, Bob, for joining us today. I want to thank our attendees for joining and participating with questions. That concludes our call for today, and thank you everybody for attending.
Thank you much.
Thank you, Andrew. Thanks, everyone. Have a great afternoon.